Hello friends, welcome to Learn Easy. We will discuss the role of hedge funds in financial markets. A hedge fund is an actively managed investment that pools money from accredited investors and seeks high returns by using complex strategies and significant risk. These funds use smart methods to choose what to invest in and how to handle risks. The main aim of hedge funds is to make the most money for investors while also being careful about risks, no matter if the market is going up or down. Unlike regular funds that usually invest in stocks or bonds, hedge funds can put money in many different things like real estate or currencies. One request, if you are new to my channel, please subscribe, share and press the notification bell. There are mainly 4 types of hedge funds. First type, activist hedge funds. These aim to invest in businesses and take actions that boost the stock price. Some of the common activist actions can be changing the board of directors, increasing global visibility, engaging in CSR work, cost cutting, etc. Second type, equity hedge funds. These funds aim to invest in equity in both national and international markets. These track stock or stock indices that hedge against the downward movement of the stock market as they are overvalued. Third type, relative value hedge funds. These funds seek to exploit temporary differences in the prices of related securities, taking advantage of price or spread inefficiencies. Fourth type, global macro hedge funds. These are actively managed funds that attempts to profit from broad market swings caused by political or economic events. These hedge funds look for different macro factors around the world and take advantage of market movement depending on global factors like socio-political scenarios, war and other disturbances, currency fluctuations, inflation, political relations, etc. Now, let us see the features of hedge funds. Here are the salient points to note how hedge fund works. First feature, smart management. Hedge funds are taken care of by experienced experts who use special plans based on what is happening in the market. Hedge funds pool money that is managed to outperform average market returns. The fund manager often hedges the fund's position to protect them from market risk. Second feature, alternative strategies. Some of the assets are invested in securities whose prices move inversely to the fund's core holdings. If their prices drop, the securities prices should rise. As a result, the hedge can offset any losses in the core holdings. For example, a hedge fund that focuses on a cyclic sector such as travel may invest a portion of its assets in a non-cyclic sector like energy, aiming to use the positive returns of the non-cyclic stocks to offset any losses in cyclic stocks. Third feature, clever strategies. Hedge funds use special ways of investing to try to make more money. The fund managers may do things like betting against certain investments or borrowing money to make even more profit. Fourth feature, flexible. Hedge funds can quickly change where they put money. which help them deal with different situations. Investments are considered illiquid as investors have to commit their money for at least 1 year. Fifth feature, risk management. These funds try to be careful about risks by spreading out their investment and using tools like diversification, hedging, and risk assessment models to protect against losses. We have to keep in mind that while hedge funds can make more money, these can also be riskier and more complex. So, these funds may not be right for everyone. Sixth feature, costly. Hedge funds usually charge a managing fee and a performance fee. The management fee is a percentage of fund's total asset, and the performance fee is a percentage of the fund's earning. Seventh feature, accredited investors. Hedge funds use risky strategies, leverage, and derivatives securities like options and futures. Therefore, hedge fund investors are almost always accredited. This means they meet a required minimum level of income or assets. Accredited investors are typically institutional investors such as pension funds, insurance companies, and wealthy individuals. However, there are some benefits of hedge funds. One request: if you are new to my channel, please subscribe, share, and press the notification bell. First benefit, potential for high returns. Unlike traditional investments, hedge funds try to make more money by using special methods that can bring in more money. Hedge funds can be risky, but they may also make greater profits, especially when the market is volatile. Second benefit, adaptability. Hedge funds can use techniques to protect against losses. This helps them handle risks and may lessen the effect of market slumps. Third benefit, expert management. Hedge funds are handled by skilled professionals who use their knowledge to make smart investment decisions. There are various types of hedge funds according to the strategies they use to invest or the types of assets they invest in. Let us compare hedge funds with mutual funds. Regarding investors, in hedge funds, few numbers of investors, accredited investors. In mutual funds, a large number of investors. Types of investors, hedge funds, high net worth individuals, HNIS, ultra HNIS, UHNIS, insurance companies, banks, pension funds, etc. Mutual fund, mostly preferred by the retail investors. Costs, hedge funds have the fixed management fees and percentage of the profit. Mutual fund, a fixed percentage of the asset under management AUM, known as the expense ratio. Minimum investment, hedge funds, high requirement. As per the SEBI rules, the minimum investment is rupees 1 crore. Mutual funds, low minimum requirements. Generally, it is rupees 500 and starts from rupees 100. Liquidity, hedge funds, less liquid, 1 year lock-in period. Mutual fund, highly liquid. Risk, hedge funds have higher risk as they use complex investment strategies. Mutual funds, less risky, depends upon the investment objectives of the fund. Return, hedge funds, high potential returns. Mutual fund, depends upon the market conditions, chosen asset class, investment horizon, etc. Transparency, hedge funds, low transparent, mutual fund, high transparent. Regulations, hedge funds, low regulations, mutual funds, high regulations. So, it is clear now who should invest in hedge funds. Hedge funds are not suitable for everyone. These are designed for wealthy or high net worth investors because these funds have high investment requirements. Hedge funds are a little bit like expert managed mutual funds. These are often chosen by people who have enough money to spare, are financially secure, and are okay with taking some risks. So, it is a good idea to get into hedge funds when we are more experienced or when we find a manager whom we can trust. Investing in hedge funds can be tricky, so it is important to be sure about our choices before diving in. We should spend a fair amount of time choosing between different hedge funds for investments, as not all funds in India or across the globe can generate positive or efficient returns for the investors. Let us conclude. Hedge funds are actively managed funds focused on alternative investments and commonly use risky investment strategies. Investing in hedge funds is generally open to accredited investors with a high minimum investment or net worth. Investing in hedge funds is often considered a risky alternative investment choice and usually requires a high minimum investment or net worth. Hedge funds charge higher fees than conventional investment funds, and it is usually locked up for a year before shares can be sold. That's all. Thank you for watching the video.